As the U.S. markets are closed for the weekend, the Tesla stock, ticker TSLA, is holding its closing price from Friday, November 14th, 2025, at $404.35 per share. That session ended with a gain of 0.59%, or $2.36, which on the surface looks like a quiet, positive end to the week. But that single number is perhaps the most misleading piece of data you could look at, because it masks a brutal reality that many investors are just now waking up to. The common expectation is that Tesla, a core holding in countless portfolios, from sophisticated Schwab Intelligent Portfolios to SoFi Invest accounts, is the undisputed leader, a perpetual growth machine. The reality, however, is that this stock just capped off a punishing three-day slide that erased 9.7% of its value. And more importantly, this latest drop has officially pushed Tesla stock back into the red for the entire year. As of this moment, it is the only member of the Magnificent Seven that is down year to date, a fact that is causing a seismic shift in sentiment and forcing a hard reevaluation of its future. That Friday session wasn't a calm recovery, it was a desperate battle. After closing above $401 on Thursday, the stock gapped down hard at the open on Friday, starting its day at $386.30. It plunged even further, hitting a low of $382.78 as panic sellers and automated systems on platforms like Interactive Brokers likely triggered stop losses. It was only a late-day rally that clawed the price back over the $400 mark on staggering volume of over 105 million shares. This wasn't a healthy bounce. It was a high-volume, high-volatility scramble. This recent plunge, which included a severe 6.6% drop on Thursday alone, was fueled by a trifecta of terrible news that challenges the very foundation of the bull thesis. The general belief has always been that Tesla's dominance is inevitable. The new reality is that its dominance is under attack from every conceivable angle, and the cracks are finally starting to show. Investors who just invest online and look at the 5-year chart are missing what's happening right now. So what's driving this sudden violent repricing? First, the China problem is no longer a problem, it's a crisis. New data shows Tesla's sales in the world's largest EV market are in a free fall. October deliveries were a shockingly low 26,000 units, a 3-year low that has seen its market share collapse. For the first 10 months of 2025, Tesla's sales in China are down 10% compared to the previous year. This is happening while domestic competitors are surging. This isn't a blip, it's a rout in a market that was supposed to be a cornerstone of future growth. Second, the bad news is now coming from inside the house. In the last few days, key leaders for the Cybertruck, Model 3, and Model Y programs have all departed. This isn't normal attrition. This is a brain drain at the worst possible time, signaling potential internal turmoil and a loss of faith from those who know the company best. And to add insult to injury, the company just issued a recall for over 10,000 of its residential Powerwall 2 energy storage products, citing overheating and fire risks. While the NVIDIA stock continues to post gains on the AI hardware boom, and Apple stock remains a fortress of profitability, Tesla is dealing with fires, both literally and figuratively. This string of bad news is what institutions are reacting to. We're seeing major players, the kind that use Fidelity Wealth Management for their block trades, get very nervous. Prominent bull Cathie Wood's ARK Invest, while still a massive holder, has been consistently trimming its position, selling off tens of thousands of shares. The latest 13F filings from Friday paint a picture of pure chaos and confusion. For every fund like Cadenza Capital adding to its position, you have another like Raton Capital Management dumping its shares entirely. And the options market is a hornet's nest. We see massive, complex, and opposing bets from firms like SquarePoint Ops and Natixis, with huge put positions, a bet the stock will fall, being balanced against equally large call positions, a bet it will rise. This isn't conviction. This is high-stakes gambling on where the stock will lurch next. The retail trader, the person using the Robinhood app for Robinhood stock trading, is caught in the middle of this institutional tug-of-war. This volatility is all happening in the shadow of the company's last earnings report from late October. On the surface, Q3 2025 looked okay, a miss on profit per share, but a beat on total revenue. But the market has had weeks to digest the fine print, and it does not like what it sees. The real story was the catastrophic compression of profit margins. GAAP operating income was down 40% from the year before. The all-important operating margin shrank to only 5.8%. This is the core of the bear argument. Tesla is being forced to cut prices to maintain sales volume against rising competition, and in doing so, it is destroying its tech company profit margins and exposing itself as just a car company. And a car company, even a great one, does not deserve the eye-watering 270 times earnings multiple that Tesla stock still commands. For those who are new to this story, it's important to understand what Tesla actually is beyond the headlines. The company is split into two main parts. The first is the one everyone knows, the automotive segment, which designs, builds, and sells the Model Y, its dominant seller, the Model 3, and the high-end Model S and X. This segment also includes the Cybertruck, which, after all the hype, is proving to be a niche product. New reports show Cybertruck sales are down 38% this year versus last, with only about 16,000 units sold in the first 9 months of 2025. The second, and arguably more critical segment, is energy generation and storage. This includes the Megapack, a massive battery for utility companies, and the Powerwall and solar roof for homes. This direct-to-consumer model, with its own supercharger network, has always been its moat. But as competition builds its own networks and other companies enter the energy storage space, that moat is looking less and less imposing. This brings us to the central tension for anyone considering an investment in Tesla stock, whether it's through Fidelity Brokerage or a SoFi active investing account. You have two completely different narratives, and which one you believe determines whether you see this as a $100 stock or a $1,000 stock. The first narrative is the bear case, the reality that the recent price action seems to be confirming. This argument states that Tesla is a car company first and foremost. Its margins are collapsing due to intense competition and weakening consumer demand from high interest rates. Its China growth story is over. Its executive team is fleeing. Its Cybertruck is a flop, and its valuation is a fantasy left over from a different time. For these investors, the stock is still wildly overvalued and has much further to fall. They see Fidelity ETFs that track the S&P 500 as much safer bets than this high-wire act. The second narrative, the bull case, the expectation that has defined this company for a decade, says that analyzing car sales and profit margins is a fool's errand. It's like trying to value Apple stock in 2006 by only looking at iPod sales. The bulls, including those at Fidelity Investments, argue that Tesla isn't a car company, it's an AI and robotics company that just happens to make cars to fund its true mission. For them, the recent bad news is just noise. The real reality they are betting on includes a Tesla supercycle built on future catalysts. First, the robotaxi and full self-driving network. With FSD Supervised now available as a $99 per month subscription or an $8,000 one-time purchase, the company is gathering billions of miles of data. Bulls believe the eventual launch of a fully autonomous robotaxi fleet would be an event that could quintuple the company's valuation on its own. Second is the Optimus humanoid robot. The company is already using them on its own production lines, with a wider production slated for 2026. The CEO has stated he believes Optimus could one day account for 80% of the company's entire value. And third is the energy business. With the AI boom from companies like NVIDIA stock creating a global electricity shortage, the demand for Tesla's megapacks to stabilize power grids is exploding. And Tesla is even designing its own AI chips, reportedly working on a new version 40 times faster than its last one. This is the great divide. Is Tesla a car company in decline, or an AI and robotics company on the verge of its next massive growth phase? The analyst community is just as split as the institutions. The consensus rating is a hold, but the price targets are comical in their range, stretching from a low of $120 to a high of $800. This is what happens when the expectation and the reality are at war. So, as an investor, you are forced to make a choice. Are you buying into the immediate, tangible reality of collapsing margins, failing China sales, and departing